Well, welcome back to Over the Money Fence, the podcast that helps you take control of your finances with clarity and confidence. And we are delighted to have our favourite money expert back with us, Roger Montgomery, founder and chairman of Montgomery Investment Management, who is also a professional investor and well-known media commentator.
Great to be with you.
Yay.
Yay.
Did you have a good break?
I did. I had a great time.
You've been skiing.
We were in Japan. I had a son, I have a son who has been living in Japan for about 3 years, living in Tokyo.
Oh, I forgot
So
that.
it was our sort of a regular thing to go and visit him in Tokyo, spend a few days with him, and then all of us would go together to Niseko or Hakuba to ski. And what's great is he now lives or has been living in New York, and my other son's been living in New Zealand, and everyone got together and reunited.
Oh, I love
and we went skiing, which was great.
It's great when the kids move overseas.
And my daughter who lives at home with just mum and dad because the boys have moved out and live overseas, she was super excited to have her big brothers with her. The snow was great. The people were great. The food's awesome. My daughter had a friend from school who also coincidentally was in Niseko at the same time, and when we asked where they were staying, we looked up and we could see into their room across the road.
Stop. Oh, that's bizarre.
Could see into
no nudie
ours.
runs. How fabulous.
You could keep an eye on each other. That is so good. Give it 2 more years.
Well, you're lucky with the snow.
We were literally in apartments across the road from each other.
We were in 40 degree heat in Australia. And look, honestly, I've been very, very social, and so has Nicola over
I saw online. I've been watching you on Instagram. Yes, you've been very busy.
We're stalking you.
No, you asked me to follow you.
That's dangerous.
He didn't say that. No, we've had a great, because I've had a lot of family here from overseas, and it's been crazy. But I will say, one thing I will say is many a party that Nicola and I are at, cityside or up at the beaches, like how many people, like we have a lot of guests on our podcast, and this is our 4th year. They talk about you, Roger.
Thank you.
That's very kind.
In particular, women that who I obviously like myself, who have been not as confident around even just the word finance. I just glaze over.
Of course.
Not so much now, because you've managed to educate me. And I think the comments, as Nick and I were saying in the car, is you keep it simple.
Yeah.
Number one is keep it simple, stupid. Isn't it? The KISS
principle
theory.
Yeah.
You keep it simple.
Occam's razor.
You make you can create clarity in a cloud, and this is the feedback, isn't it?
Clarity,
I just made that up, actually.
Gee, you're getting poetic. I like that, but that's very true.
That's the feedback, isn't it? I'm not just making this up, Roger. This is feedback from people over the Christmas break, and it's really good to, because Nicola and I, everything about the podcast is feedback. It's everything.
Yeah.
We can talk till the cows come home, but hey, well, how are you reacting to that? How are you responding to that? And with you, for some reason, I don't know what it is, Rog. You're easy on the eye, maybe.
We're going to say we can't start it off with Tom Cruise again. That was last year.
That was last year.
Another one. Anyway, that feedback's
I've
great.
aged a year and Tom Cruise hasn't.
Oh, that's so funny.
Definitely not
I'd like
him.
to compare bank
Bermuda.
balances there. I don't know, but
Anyway,
I
it's
put
good
my
feedback.
finances in
It's really
with
good
Roger.
feedback.
But it is true. But you know what? That's true. But it's also what people are saying too is like they're capable, but there still is that like lack of confidence there. In that area of they're confident in other areas, but it's like still and like nearly a little bit of sense of sort of shame going, I should know it by now, but I don't.
Well, I think the reason
still happening.
There's a combination of reasons. Number one, it's unknown. It's not the normal language of people.
Yeah.
There's only a small number of people who work in my industry relative to the population of Australia, and so it's not normal to talk about money. And then, of course, it's always been seen as a very private thing.
True.
And so people feel a little bit embarrassed, or they feel a little bit cautious, which is understandable, and they want to keep it private. So if you're keeping something private and you're not talking about it, well, you're not going to learn about it, or it's difficult because you're not having those conversations. And I think the combination of those two things just means that the lid has been kept on the subject. But the other thing I'll say is my industry is really, really good at making you feel like you need us. And you probably don't always need us. You know, there's a terrific quote from now past Charlie Munger. Charlie Munger worked with a man named Warren Buffett, who is one of the richest men in the world, and he did it all through investing in companies on the stock market and investing in other people's businesses. But Charlie Munger said this. He said, "What witch doctor has gained fame and notoriety by prescribing 2 aspirin?" In other words, you've got to do the big rain dance, and you've got to, do a secret handshake, and there's all this stuff that we make you think you need us for. But really, it's not that complicated. So by, I think, simplifying things for people, what I'm trying to do here, what we're trying to do through Over the Money Fence, is just make people realise, you know what, it's not that scary. You should be having conversations about it. And here, look, let's go through some examples of what you can do.
And
it's true, isn't it? Here
absolutely,
with that,
100%.
because it is, that's sort of repeating about money confidence. And today's one really is all about money confidence. So you can tune into the past ones. I love,
that's a great idea to go back if you haven't heard Roger's
the 3 buckets
segments.
is really popular as well.
Well, that was a really simple way of thinking about you know, for people who are approaching retirement or in retirement. How do you think about managing money, especially if it was your ex-husband or your partner who's now passed, and it's left to you now? You're going to be having family members wanting to give you advice or friends wanting to give you advice. Well, by having that bucket strategy in mind, you can think about where that advice sits. Yeah. Okay, that goes in that bucket, or that goes in that bucket. And I know I talked about this a lot last year, but you need frameworks. You have to have mental frameworks for thinking about how to deal with everything, with relationships, with business, with jobs, food. Everything's got to have a framework. And then if you have that framework in mind, everything is simplified. Everything's a lot easier.
It's so good.
So, look, I was going to start with, hey, let's talk about 2026, the markets. But can I preempt that with... I read an article a week or so ago, an article you wrote in The Australian. Can we start with that? Sure. Just unravel what that particular article was about.
So it was pretty straightforward. Most people, through their superannuation, will have investments in the stock market, and then many of your listeners will have personal relationships with people in my industry and have lots of exposure directly in the stock market. And the article was saying, well, the world's changing quite dramatically. So since the global financial crisis, we've enjoyed some really big tailwinds that have helped stock market returns. So we've had low inflation, we've had declining interest rates, we've had positive economic growth, we've had a global rules-based order that lowered volatility and kept everyone sane and made people feel it was safe to go into the stock market. And then we had unconventional, when things went awry, if we had a crisis of any type, for example, the pandemic, then central banks engaged in what's called unconventional monetary policy. So don't worry, don't glaze over about that. All it means is that central banks found weird and wacky ways to keep things going, to keep the band playing, and to keep the dance lights dimmed so you could boogie.
I love that.
We like a bit of boogie woogie, don't we, Ty?
Great analogy, right?
But all of that is
this
changing.
Is a great way of...
All of that's changing. And the other thing that's happened is for years and years and years, Generation X, my generation, and the baby boomers, we've benefited from asset prices going up. The stock market's done really well. Property prices have done really well. But that's shifting too now. So we've got a larger cohort of younger people who are saying the politics that benefited the baby boomers and Generation X, that's not helping us anymore. We can't afford property. We aren't making a lot of money anymore.
It's true.
So we're now going to vote for the parties that are going to redistribute that money, tax more. You're seeing it now with a consideration about capital gains tax and whether the discount on capital gains tax is going to be reduced for holding assets for more than 12 months. And so the politics, and this is global, it's not just in Australia, the politics of money is changing. The who is elected is going to be changing because there's a generation of voters now that are saying we missed out and now it's our turn. And so that means that the tailwinds that benefited the stock market in the past are not going to benefit the stock market. And so you need to be thinking about other investments. So last year we talked about private credit, for example, and we talked about high frequency trading or arbitrage funds, what are called alternatives. And those, in the article in The Australian, I was saying, well, these are the reasons why in 2026 it's going to be even more important that you consider those sorts of investments, because the tailwinds that have helped the stock market, helped the baby boomers, helped Generation X, those tailwinds are fast changing.
I think that's fascinating, because when you sort of think of, in the article too, was like, with stocks, was it with Microsoft and PayPal and even Spotify, those ones there, they've all dropped.
They've tanked.
And
they've actually fallen a
incredible
lot.
that way.
Yeah.
And, and it's funny with the whole, we even had something with David the Medium, but it's like then with so many things are changing, that it's no surprising with financials, those traditional ways, it's all going to be really sort of like changing so much.
Yeah, and so we've been advocating for our clients, if they're looking at investing more money, that they think about these diversification options. And diversification's another boring glazed over I
No, it's
word.
not. Diversification, it's logical. I get
it's-
that. Rather than just every lump sum into something.
And if you
That's fine, I love
diversify it, you want to diversify. You want to invest in things that don't move the same way as your existing investments. So you want things that go well when your existing things go badly. And three of the funds that we talked about last year have, with the exception of 1 month, have never in 8 years had a negative month. They've been positive every single month. The private credit funds have been positive every single month, and the alternative or the arbitrage fund has only had one negative month in 4 years.
Can we take this opportunity? Can you just unpack private credit for our listeners that don't know what that is?
So instead
I know
of
we've talked about it in the past.
I'll make it really simple.
Yes.
It's really, because you've brought it up a few times, and I think it's really relevant now more than ever.
You can invest in a business two ways. You can own the equity of the business. And if you own the equity of a business, if you own a piece of the business, what it means is that if the assets were all sold and the debts were all paid off, what's left is the equity. And as an owner of the business, you're last to be paid in the capital, what's called the capital stack. So if you think about, and above the equity sits the debt. And they're paid, creditors, secured creditors are paid first in any winding up of the business. And that's the other way you can invest with a business, by lending them money. So private credit has emerged globally as a way to lend to businesses. And why would you want to? Well, what's happened since the global financial crisis is banks have pulled back from lending to lots of businesses. They still lend massively, but they're lending to the bigger businesses, and they're lending to those bigger businesses because the regulation changed after the global financial crisis. So what's happened now is there's a big gap, $400 billion gap in Australia between what small and medium corporates in Australia would like to borrow for growth and what the banks are willing to lend them. And so that gap is now being filled by private credit providers. And there's different, just like in the stock market, there's different risks. You know, if I invest in BHP, that's a different risk to investing in no hope mining. You know, and you know, four white pegs in the ground. They're different risks. And with private credit, it's the same. There's different risks. There are some private credit lenders or funds that invest in property developers, and that's a very different risk profile. We don't. Our funds that we offer our investors don't have any private lending or private credit lending to property developers. Then there are others that invest. The loans are 5 years long. And that's a different risk profile to lending for 4 months, because if the economy deteriorates, well, it's more likely that it could deteriorate in 5 years over the next next 4 months. So there's a different risk profile there. And then, of course, you've got the different sizes of loans. So some funds, for example, they might just have 5 loans. And they're all really big. So if one of those loans goes bad, well, it could have a big impact on the return of the fund. Whereas some of the funds that we offer, they've got 10,000, 13,000, 14,000 loans, and the average size of the loan might be $100,000. And so if one loan goes bad, it has less of an impact on the returns of the portfolio.
And what about AAA rated? How does
Well,
that
yeah,
come
and then
into
there's
play?
different. Well, you see, a lot of the funds rate themselves. It's a bit like marking your own homework,
Right, I
right?
love
Whereas
that.
whereas
used
the
to.
manager who manages, the manager who manages,
I think I did too.
the manager who runs the funds that we distribute in Australia, they've externalised that rating process, and they're using the same firm that rates some of the banks' loans,
Oh, that's
and
great.
they've independently rated it AA for the retail fund and BBB for the wholesale fund.
You know what? It's
And
so,
both are investment
it's
grade.
so good to hear this, Roger, too much
It's
for,
really
for all our
important.
listeners just with private credit. So it's really, correct me if I'm wrong, then it's really going to become more mainstream then.
It's already becoming
There you
mainstream.
go,
It's,
which is so
bigger
good,
and bigger
yeah.
and bigger. And that's why last year you saw ASIC focusing on private credit and saying we need to have consistency across all the providers and we need tighter regulation. And the manager who manages the funds that we distribute, they were one of the fund managers that were selected to be reviewed by ASIC. And they, no one has a perfectly clean bill of health, but the suggestions that ASIC provided them were very minor.
Yes.
And so we're really confident that they're a great manager and they're doing a very good job. And their track record, while, the future's might not look like the past, they've had 8 years. Their oldest fund is 8 years old, more than 8 years old, and in that more than 8 years, they've never had a negative month.
We love that.
So imagine the stock market falls and you get a positive return. Around the barbecue, everyone will want to know what you're doing.
Of course,
Yeah.
absolutely. All right.
Yeah,
Look, while we're there, while we're on it,
Well, we're on it.
let's just head into the markets. Let's go into 2026. Let's look at
Yeah.
what's happening with the markets because
Well, the big story of
it's pretty
2025,
unpredictable out there.
the big story was AI.
Look at me, my
Yeah,
arms.
I know.
folded.
Are you guys
Hey,
using-
come
My arms
on.
fold?
This
Look.
one's a bit defensive.
I know. I just
arms
get
down.
the share market frightened.
Do you guys use AI at all?
A little tiny bit.
A little bit. So tell me, what have you done with an AI agent?
ChatGPT,
Yeah.
I guess I do that.
And what do you ask it to do for you?
If I want
A
more
lot.
knowledge than what Google could offer me, I'll just type in something and it's amazing.
Yeah, okay.
And,
It blows
and
my-
corrections
Okay,
on
he's heading
things
somewhere
and-
with this. Where
Yeah.
are you heading with
No,
this?
I use
Where
it
are you
now as a
heading?
tool. You know how you use Google?
Yes.
Like a
Yeah.
lot. To me,
Yeah.
it's a alternative to that. And also, I'll ask questions or, want to know something or even whether it's even travel or updates or corrections. And so I use it for a lot. Like I'd use Google something. It's
Yep.
like ChatGPT. I do it that way. Yeah.
So it's
Daily.
It's the ability of people so let me say this: the pattern of people discovering what AI agents can do for them is increasing exponentially, and it's just getting faster and faster. The tools are getting faster, but people's adoption is exploding. Most people use AI to streamline their web surfing. So they go onto Google, they type in a question and the AI gives them the answer. They don't even go down and explore themselves the pages anymore. So in that sense, it's saving people time. It might not be accurate, but people aren't checking that. But what's happening now is AI agents are starting to become autonomous in the sense that you can embed them on your computer. So there's one that's been released recently called OpenClaw. OpenClaw.
there we go.
And OpenClaw is fascinating and disruptive because and it's really at the moment it's still for AI coders. It really is for people who are a little bit more advanced in their usage and understanding of AI. But I've seen it demonstrated, and I've seen it embedded in someone's computer, and it's answering emails, filing emails, booking a restaurant, for example, and it couldn't. In the demonstration I saw, it couldn't book the restaurant online, so it called the restaurant.
And it was a
spoke.
robot. We We like lobster.
spoke to the maitre d'
You know,
or
it
spoke
doesn't
to the
surprise me now because when
and
you
made
think
a booking.
of cars,
Well, it didn't actually make a booking. There were
drive.
the restaurant
so
didn't take
AI
bookings.
AI
Yes.
and the markets in 26.
So I'm
Well,
coming
that's
to that. So I'm
yeah.
coming to that.
I know you
so,
are. It's
so
killing me.
as
no.
I need a choc top now.
Yeah.
so as people
Yum.
as people change the way they interact with these AI agents or agentic AI, and as people realise how much more it can do, investors are looking at some of the existing businesses, software, legal firms, data firms, and saying, you know what, these companies are dead men walking. You know, they're going to be disrupted and they're going to go out of business eventually because AI can do what they're doing easier, faster, and in a more user-friendly fashion. So I don't need to pay that subscription anymore. So the big investment theme that made people a lot of money over the last 10 to 20 years has been software as a service. So remember in the old days, and you and I, we can remember this, but maybe some people listening won't remember this, but I can remember when I wanted to upgrade Excel and Word and PowerPoint, you know, Microsoft Office, I had to go to a store, I had to go to JB Hi-Fi,
Sure.
and I had to buy the discs in a box. And then I had to load the discs on and wait for them to upload, and that's how I did it. But very quickly, software companies worked out, hey, there's a physical cost in producing those discs. Then we have to ship them. We can get rid of all of that by just, when the cloud was invented, putting the software in the cloud and selling a subscription. And hey, if you pay us, you know, $150 a year or $150 a month or whatever it is, you'll get to use Excel and Word. And that is the most ubiquitous, probably the most ubiquitous software in the world. And so software as a service where you subscribe became the dominant business model. And now we're seeing it across everything. In fact, I watched, you'll have to indulge me for a minute.
Please.
I watched a fascinating episode in the 7th season of Black Mirror.
Okay.
Where a woman had an injury and part of her brain was damaged. And so a software company provided an artificial version of that part of her brain that controlled her speech and her thoughts and so on. This is completely hypothetical, but this is Black Mirror for you.
Yeah.
And the only problem was that they didn't have a lot of money. The couple didn't have a lot of money, but it worked brilliantly. And you had to subscribe to the service because it was in the cloud.
Okay.
Now, if you went outside of the range, outside of the zone, and there were no towers, she became comatose again. But, of course, if you upgrade your subscription, you can have all of America covered and you won't become comatose and turn into fall into a vegetative state, but you'll have to pay more. And then, of course, what happened is the company upgraded the plan, and the old plan that they had upgraded, the couple had upgraded to, offered ads. And so the woman would be teaching at school, she was a teacher, and she'd start saying, looking for new stationery? Well, guess what? We're on sale now. Go to.
We have to watch it.
You have to see it.
We are going to put the link in the show notes.
So
everybody,
I think I'm getting where you're heading with
Point
this.
being, people start.
He's gone left field, but he's taking you on a journey. I'm with you.
People start to
Go on.
resent the subscription model.
Yes.
Right?
Right.
So now what's happening is AI, people are realising these AI agents could completely disrupt the software as a service subscription model. And if they do, and people will adopt them in greater numbers because people are already resenting subscribing and you've got to be upgraded to stay on the old plan.
Totally.
It's costing more. Or you can upgrade to the new plan. You know, people are starting to resent this and everyone's doing it.
Yeah.
You have to subscribe now to have, my wife just bought a new car and it's her first new car ever. She's always had...
Kerry from the Ferry.
Yeah, she's always had a...
Tune in to the one from last season how Roger met Kerry.
Yeah, that's right.
Great one.
And so, you know, to my delight, Kerry agreed to buy a brand new car that she could specify. But then when we were at the dealership, they said, well, if you want this, you have to subscribe to it.
Oh,
you have to
please.
subscribe a monthly. Hang on, I bought the car, I own the car, but now I have to subscribe to software updates or
They
the
wouldn't
superior
throw that in?
version. No.
Oh, gee.
And this is the point. So people are becoming resentful.
Yes.
AI potentially disrupts it. So then investors are saying, well, hang on a sec, if we put those two things together, then the SaaS business model, software as a service, that business model could be really, really disrupted. And you mentioned some stocks that have fallen a lot.
Yes.
And so what we've seen over the last, and it probably started before AI, but we're seeing a lot of these software as a service businesses, their share prices are collapsing. And so the big story this year will be, what else will be disrupted by AI? What else?
The world is changing
Yeah.
so
What
many
else is-
ways.
exactly.
Strap in.
Yeah.
And so that's why this year is going to
The
be
year
a
of
more
the horse.
volatile year. It's going to be a
More volatile.
I think, and of course, with Trump at the helm for another year and becoming potentially increasingly desperate as his popularity declines, that's going to result in a lot of upheaval and a lot of desperation in politics, and consequently, we're going to see some big shifts, and that will be reflected in stock markets by them being more volatile.
I was wondering, Roger, I know this was there, but with looking at some of those stocks that have dropped too, and then sort of with the Epstein files too, and some of these big names, would that be an effect as well? People now are going, well, look.
Well, we're going to see, I think, increasingly desperate attempts to distract from the Epstein. Greenland, the whole idea of buying Greenland, some argue, is just a decoy to take the attention away from the Epstein files or something else. And that whole distraction strategy is part of the Republicans' administration's
distraction.
playbook. and rightly or wrongly, some
Yeah.
people, I'm not making any political,
No.
from an investment perspective, it will produce more volatility, which is why things like private credit and alternative funds make a lot of sense, because that volatility, you can diversify away from some of that volatility. And this year, you and I will have a lot to talk about because there's going to be a lot more volatility.
It's funny, I've got a friend that's invested in private credit. She has every month X amount of dollars come in that she knows of. She's invested in shares, funnily enough, they've dropped.
Right.
And she's freaking and worrying and whatever. And I'm like going, well, at a certain age, it gets to a point where you want some sort of a natural flow every month of money that is coming in, so you can rest and be at peace with that, rather than running with the share market at the moment where there is so much volatility.
For a lot of people, just not being able to have that part of your life steady.
Yes.
When there's so much
Steady
else in
Eddie, I
life
love it. Yeah.
that is uncertain.
Yes.
If you know that, for example, from private credit, between 7 and 10% a year, every month you're going to receive a cash payment, then you don't have to think about that anymore.
It's soothing.
Whereas a lot of people, for a lot of people, that hasn't been available before.
And a lot of people weren't aware of it.
Yeah.
And just sort of with that, we're sort of saying, today's also for people listening to gain more confidence. And also, it's an emotional thing. And I know sometimes you go emotion and money, you have to keep it separately. But how do you do that? Because, a lot of, especially women too, when you're at this stage. And, so you're thinking, where am I at? What am I going to do? Or circumstances have changed. And how do you keep the emotion?
The first thing to remember,
you feel overwhelmed.
The first mistake you can make with money is rushing to do something.
Yeah,
Right.
The other mistake you can make is doing nothing. Right.
Yeah,
interesting.
Yeah.
Happy medium.
Freeze, isn't it? Freeze,
So doing nothing is not appropriate, but rushing into something also is probably not appropriate. And I said last year, and I'll say it again, you don't have to rush. You can take your time, but you need to be thinking about it and making progress. It's also really important. I personally believe it's really important to understand that money doesn't care about you.
Yeah.
Money doesn't have emotions. You have the emotions. And if you make decisions emotionally, they'll often be the wrong one. Whenever we say something when, we're full of emotion, it's usually the wrong thing. So when we do something with money and we're doing it with emotion out of fear, or out of greed, they will often be the wrong decisions. So it's really important that we try and have an even keel and we're balanced before we start thinking about pulling the trigger on money decisions. You can build up what you think the money decisions should be. You can write those down. I think I should do this. I think I should do that. Someone's telling me to do this. I think I agree with them. Write it all down, but you don't have to pull the trigger immediately. And you want to pull the trigger when you're calm and relaxed and you believe you have all the information.
It's funny you mentioned the word fear.
It's good to hear that.
mean, right now, with gold stocks, we cannot have this conversation and not mention golds and silver and rare earths. I'm asking you the fear factor globally at the moment because of the unpredictability. Tell us about the effect on gold stocks, silver and rare earths.
So what's happening globally is central banks around the world, from the biggest buyer of gold, the biggest central bank buying gold at the moment is Poland.
Really?
Yeah, and China and India.
Lovely country to visit. I went on a holiday there last
astounding.
year.
There you go.
Highly recommend
Yeah,
it.
they've been the most aggressive buyers of gold.
Krakow.
But point being, there's dozens and dozens of central banks around the world that are accumulating gold. And then the question investors ask is, well, why is that? And, there are some countries that fear that they'll make decisions that will cause Trump to put sanctions on them or impose sanctions on the country. And if that's the case, well, having gold actually helps them deal with those sanctions a little bit more securely. And because of some of the US administration's behaviour, blocks are forming outside the US and away from the US dollar. And so investors and central banks are saying, well, if the US dollar declines, our investments in US dollar assets will decline and we need to protect that by owning more gold. And so that theme, by the way, we've known about that for years, that central banks are buying gold. And what's happening now is, I often say what intelligent people do in the beginning, less intelligent people do at the end. And so people are buying gold today because of what I've just told you, as if it's new information.
Yes.
But it isn't new information.
No. Yeah.
It's been driving the gold price for 5 years, even longer.
There's a lot of more volatility and uncertainty in the world, though.
And what's happened recently, it went vertical. The price of gold and silver went vertical. And what we know through experience is that prices can't sustain a vertical trajectory for very long. And they often crash. Whatever it is will often crash after a vertical price rise. So it could be that gold goes from $5,000 US an ounce to $10,000 US an ounce. That could very well happen, particularly if we see geopolitical conflict turn into military conflict.
Yes.
You'll see gold spike.
Yeah.
And I think that's probably why some people are buying gold. But you know what? Probably the silliest thing you can do is buy physical gold. You don't need to.
Aren't they lining up near your
I've
office?
got a little bit
They
of it
are.
on here.
That's
I like
fine.
my gold.
Jewelry's fine. Jewelry's fine. But people are buying, they're buying ingots of gold and storing them under the bed or in a safe at home. And that doesn't make any sense for two reasons. Number one is if you're a prepper and you believe that owning gold is going to protect you if the world went chaotic and there was no rules and there was no law and order, I promise you anyone who's got gold will be killed for it. Right? You're a target by owning gold. You're not going to be able to walk around and use your gold to buy food, and people will attack you and steal it.
Because I've learnt with Bitcoin, that's not going to happen.
So that's the first thing. That's the first thing. You don't want to advertise that you and if you don't advertise, but people see you doing well in a chaotic environment, a post-apocalyptic kind of environment, and believe it or not, some people believe this is going to happen. People will say, hey, how come they're doing so well? I think they must have some gold. Let's go get it. Yeah. Right? So that's not going to protect you. And then the other big problem, the more immediate issue, is the frictional costs of buying and selling physical gold are about 7%. So you've got to make 7%. Your gold, when you buy gold, it has to go up 7% just for you to break even when you sell it. And that because the spread between the buy price and the sell price that is provided by the bullion companies that buy and sell gold is really wide. So a kilo of gold, for example, currently is about $241,000 to buy. But if you sell it immediately, so let's say you buy a kilo of gold and walk out of the shop and walk straight back in, 1 second later, they will buy it from you for $15,000 less. You've just lost $15,000. Now, you can own a kilo of gold on the stock market.
Yes,
You can buy an exchange traded fund.
Would you recommend that? Or?
Well, I don't know what the gold price is going to do. I own a little bit of gold just in case.
Yes.
But it's not really my long-term investment strategy because I don't know what the gold price is going to do. I believe central banks will keep buying it, but does that mean the price continues to go up? I don't know.
Because of the vertical.
Yeah, exactly.
You know what? The image I'm getting, one of those planes at an air show, it goes up.
Yes, then it stops
And
going
it has
up.
to go down. Wow.
Yeah,
So,
it's like an Elon Musk rocket.
What's that?
Like an Elon Musk rocket. It comes back
I
down.
look at his starships every night.
And that
going
was
in
one
the
of the other
sky.
ones. Tesla's
he's
gone
been-
down
I
as
think
well.
he's
too.
amazing.
Tesla has fallen.
Tesla's gone down. So with this, like we're talking a bit now with the crystal ball time, and it's like the year of the horse disruptions. I mean, what else? What do you sort of say for
Okay,
some
so I
listeners
think-
now,
so if
with
I'm-
all this info.
So you're asking me to distill everything I've read and written and thought into
I really want to know.
a bit of a grab. So I think the big companies, the biggest companies, particularly in the United States, probably won't perform as well as smaller companies in the United States, and probably won't perform as well as markets outside of the United States. So other markets, not the US. So last year, for example, there's probably 15 countries whose stock markets did better than the US, and I think that will continue.
Right.
So emerging markets, what are called emerging markets, so they're stock markets in countries that aren't first world, they're developing markets rather than developed. They will probably, I believe they will outperform. I think small companies will outperform big companies. And I believe if none of that matters to you and you just don't want any volatility at all, we're going to continue seeing lots of growth in things like private credit or alternative funds, such as some of the ones that we distribute in Australia. I'll give you an example. We have partnered with a manager that makes money from volatility in cryptocurrencies. It doesn't matter if the cryptocurrencies go up or down, as long as they go up or down. They make money from the movement, and they only put a trade on if they can lock in a profit.
That's so clever.
It is. Some people freak me out.
And they've done really well over the last 4 years. They've averaged about 21%, a bit more than 21% a year, and so. They don't care whether the stock market goes up or down. They don't care whether cryptocurrencies go up or down. They're just making profits from arbitraging the derivatives on the cryptocurrencies across different exchanges. So I think those sorts of funds this year are going to come into their own.
Wow.
So that's my, in a nutshell, summary for 2026.
Like when I'm hearing Roger, I get this piece of mind. Look, I don't mind. So I've personally invested with Roger. I'm so impressed with Montgomery Investments. The way you operate, your staff.
Yes.
Tash, we love the Tash.
Tash, we've got to get Tash on the show at some point, don't
her
we?
money where her mouth is.
No,
and she's saying it. She really is,
I talk about you to people because I think up front we were saying you calm and you put things simple. It's the way you speak, because I do not understand finance jargon, and you know that I have an issue with I have a block. But you get around that. Somehow you get into my brain and I go, okay, I get it. I understand.
Do you know what people
and other women and men too, and people.
And I can't believe I'm saying that about finance.
When you said that,
soothing.
And I want to also say for people who are sort of like saying with the confidence, or if you haven't done it before, I'm so excited when I hear Roger, because I sort of feel how so many things are changing. It's sort of new for a lot of people anyhow, so it's really a great time to learn, because everything, we're always learning every day. We're students of life, but there's such big changes.
It's huge.
It's such an exciting time.
And in my industry, there is so much to learn.
Out, anyhow.
You've got to remember, most
people
spend a lifetime developing their skill in their chosen career or their particular profession. I don't understand how they think, I'll just go into the stock market and it'll be easy. And I'll work it out really quickly. People spend a lifetime in there building their careers and building their skill set. It's the same in the stock market. It takes a long time. So don't try and do it yourself. There are experts out there. There are people out there who are honest and have integrity and want to help. And you've just got to find those people.
We're running out of time.
Yeah.
Can we just, you know how we get the feedback all the time?
Yeah, okay, let's
can
go.
We
yes.
do you wanna, some of them.
Let's.
That,
do you want to shoot with the first one? Here, I'll
Can
shoot.
you go first?
Okay.
Yeah.
Okay,
Here we
because
go,
there's
yeah.
been a lot too there.
There's
but,
been heaps. We just
I'll
grabbed
start
the
off
ones
like
we
there. Is
could,
now,
yeah.
like really, is now a good time to invest?
It's always a good time to invest, but it depends what you
Thank you,
invest
Mary,
in.
for your feedback.
Yes, yeah.
You know, if you were asking me to invest in Nvidia right now, well, it's trading at 77 times its revenue. You know, it's or you look at Tesla, it's trading 125 times its earnings. So I might say, well, I'm not sure that that's the safest investment to make. Conversely, there are companies that are very high quality and people have ignored them because they're small or they're flying under the radar. So there's always a good time to invest in something.
Yeah.
But today might not be the right time to invest in everything.
No, and I guess it's also as a thing too of it in investing in different areas too, but otherwise in sort of like sitting in a bank earning no interest really.
The thing for a lot of people, having your money in a bank just feels safe, and it is relatively safe, and you're not going to get a great return because it is so safe. But there are people who I've met. But some people who I've met, many of whom you've introduced me to, they've said something consistently, and that is, I'm just not going to generate enough income if I leave it in the bank. So you do have to move up the risk spectrum a little bit.
Yes.
You don't have to move
Really
up
good
a
point.
lot.
Yes, yeah.
And we talked earlier about private credit, and what we're discovering around the world is that for the same risk, you can get a better return. So, for example, AA rated, you could, prior to the advent of private credit, AA rated might have paid you 5%. You can invest in AA rated private credit and it'll give you 7 or 7.5. So we're finding now that there are alternative investments that you can make, and for a given level of risk, you can generate a better return. And for many women who are on their own for various reasons, often through no fault of their own, they're looking for security. They're looking for something that is relatively safe or safer, but will give them the income that they need to enjoy life. And I think this year, just like last year, we're going to see more and more money flow into those kinds of products.
Oh, that's positive.
Okay.
That's great.
One of them is a guy, John Anderson. I feel behind, but so where would I start?
Well, remember what we said last year. You're not starting behind. You're not starting again. You're starting now.
Oh, I can hear that again and again.
Well, actually, can you repeat that?
Yeah, I
because
love
it's
that.
really pertinent. I really believe
you're not
that.
behind, and you're not starting again. You're just starting now.
See?
And that
That's
gives
why
you
we like Roger.
That
It's
flips
comforting.
your mindset to realizing it's not about the past, it's about the future. And guess what? Just as I said earlier, the stock market doesn't care, money doesn't care about you. That's good to know because it's impersonal and it doesn't care about your experience. It doesn't care about your history. It's going to offer opportunities, and investments are available to you now. And the place to start is this podcast, finding some good books to read, and maybe in the next podcast we can talk about some of the authors, some of the good authors.
I'd love that.
And some books to read.
Well, you're a good author, Roger.
Yes,
Oh, thank you.
are, yeah.
But that's a very specific. My book, which was written 12 odd years ago, is a very specific book about a particular style of investing in the stock market, and that might not suit everyone. If it does suit you, great. I'd love you to buy the book. But if you're not thinking about that right now,
Sure.
that doesn't sound like it's for
We
you.
will have the link to that as
We've
well.
got some other books.
Because I've got some positive...
Some of these other questions, I was just noticing, Roger's actually covered in this
I
segment.
think so too. Should I wait for the
markets
for the markets
and
to
we're running out of
settle?
time, but I really do think.
But that is a good
guys-
question.
But okay,
A lot of
yes,
people-
that
Let's do
is,
that
yeah.
then.
A lot of
Sure.
people
Yeah.
wait
We
for the
always
stock
go
market
there.
to crash.
Right.
I think that's usually It's usually a mistake.
Okay.
Because number one, crashes don't happen very often.
Yeah.
Number two, they don't last very long. Bull markets that are rising, happen more often and last longer. And so over time, you're better off being invested than not invested. However, the most dangerous thing is to invest today and then the stock market falls tomorrow or crashes tomorrow.
Yes.
And that's what people worry about.
Yes.
Right? It's called, in our industry, it's called sequencing risk. And if you lose 50%, you have to make 100% on your remaining money to get back to square.
Yes.
Just to get back to where you were.
True.
So people fear a crash the day after they invest. So my response to that is don't invest it all at once. Invest a little bit now and a little bit next month and a little bit or next quarter and a little bit next quarter and a little bit next quarter. And then you average
Such
out.
good advice.
Now, you'll do better if the market does crash because you'll be buying more shares at a cheaper price.
Yes, that's
but you'll
different.
also be invested, which means you're paying attention to it, which is good. The only time you'll underperform doing that is if the market roars ahead and, this year it generates 20 or 30%. Then investing a little bit at a time is worse than having invested it all at once. But I don't think that's going to happen this year. I'll be very surprised if it does for all the reasons that I've already mentioned. And so that approach to what it's called dollar cost averaging, I call it dollar crash averaging. So dollar cost averaging is where you invest the same amount every month or every quarter. And dollar crash averaging is where you load up when it crashes. And that will benefit you down the track.
Yeah, absolutely.
And so for people who are worried about the market crashing, that would be my response.
Fair enough. Fair enough.
Yeah.
Well, here we go again. You know what? I feel like I've been to some sort of seminar. That's how I feel. No, I do. I learned so much.
Not one where you fell asleep.
Quite honestly, Roger, I do.
I enjoy, and I know our listeners enjoy
we're always
speaking
constantly amazed we say that, aren't
to
we?
you, Roger, because just everything there, it's just like it just all made sense. It's really interesting.
Well,
and
I
like to hear it again, and remind
you guys are my soundboard, so if I'm starting to send people to sleep or I'm starting to be boring, you always bring me back on track.
Cut you
No, Di's
good.
good because she's sort of like
I'm
looking there. I want to hear him
a real-
talk forever. I could
No, Nicola
have
and I
I
don't
have
have-
a
I'm gonna
3-hour
move on.
podcast with Di.
Now, look, if you're like us and you want to know more, so you can find more of Roger's insights at montinvest.com or rogermontgomery.com, or just simply call the team, which I have. They're fabulous, 0280465000. Of course, all this information is in our show notes.
It is too. And also with this one, share it with a friend, pass it on to a family member. We are on YouTube, so subscribe. So it's a great way. A lot of people now are watching. So subscribe to YouTube, and so really thank you for coming in.
And thanks for joining us
and
Over the Money Fence.
And also, come back with the feedback too. More questions.
Yeah, we love the feedback.
We love it. So 2026, what a ride.
Literally.
and this
hopefully it will be.
It will be a roller coaster this year.
Oh, I can't wait
It'll
for
be
the next.
fascinating.
We finished with that word.
I can't wait for the next one as well.
Thanks, Roger.
A pleasure.
Take care.
Okay, bye.
Bye-bye.